Well, the whole world is talking about a Fed cut. But what is a Fed cut and why is the world obsessing about it? A Fed rate cut refers to the reduction of the US federal funds rate, which is the interest rate banks charge each other for overnight loans. In simpler terms, it's the central bank of the US that is looking to cut rates. Now, the last time the Fed cut rates was all the way back in March 2020. Post which the Fed has hiked rates multiple times. The last rate hike that the Fed did was all the way back in July 2023. Rates since July last year have been steady in the range of 5.25 to 5.5%. This rate that we are talking about so actively influences other interest rates across the economy, affecting everything from mortgages to business loans to investments. Here's what a Fed rate cut means for the US. First up, it means cheaper borrowing cost. Lower interest rates make it cheaper for consumers and businesses to borrow money. This can lead to higher spending on homes, cars, business expansion, and potentially boosting economic growth. It also boosts investment and growth. With lower rates, businesses are more likely to invest in projects and expand their facilities. While consumers might spend more, this also helps stimulate the economy during slow periods or downturns. The stock markets also gain, which we've seen in the last few months now. Rate cuts often lead to equity markets gaining sharply as investors expect higher corporate profits from increased consumer and business activity. Cheaper borrowing cost also makes bonds as an asset class less attractive while making equities a lot more attractive. How does it impact savings? Lower interest rates helps borrowers. They hurt savers. Bank savings accounts, CDs, fixed deposits offer lower returns because of the rate of interest being lower in the economy. What it also does, it leads to a weaker US dollar. A rate cut can weaken the US dollar as investors look for higher returns in other countries such as India. A weaker dollar can also make US exports a lot more competitive abroad, but this could also increase the cost of imports for the United States. The Fed uses rate cuts, or central banks worldwide use rate cuts to control inflation. In times of low inflation or economic slowdown like we are seeing in the US, a rate cut helps to increase demand and push inflation closer to the Fed's target of 2%. However, you must remember, if inflation is already high, a rate cut might actually make it worse by encouraging spending from consumers. So in a sense, a Fed rate cut is a tool used to stimulate the economy by making borrowing cheaper, encouraging investments, boosting consumer spending, and encouraging foreign institutions and investors to invest in emerging markets outside the US that provide a better risk reward.